Well, I know you've got a spread ready to show us. You want to go ahead and pull that up?
Yep.
Okay.
Yeah,
Cool.
sure.
So tell us a little bit about what you're going to walk us through, Angel.
Yeah, so this is an example of a business that I worked on recently. Fairly large business, does pretty well. This loan, its entirety, is going to be around $6 million, right? And now the total project is around $7 million. Now, what happens is a lender will always look at the total project cost. So when you're a buyer, you want to understand the total project cost. So closing costs, the working capital, do you need new equipment, new trucks? It's better to do everything at one time, because if you try to come back to us in 6 months, it may be hard to get more capital, right? Because we're going to ask you what happened or why do you need more money? Now, sometimes the reasoning is, hey, I just landed a big deal with Amazon and I need $1 million. That's different, right? There's a contract in place. That's something we can verify, and that's cool. But you definitely want to make sure that the deal is funded correctly the first time, and that obviously the debt coverage works with that correct funding amount. So what every lender will do, will try to understand the sources and uses of the funds. So where's the money coming from and where's the money going? In this case, this is my chart that I use for every deal. In this scenario, you have a borrower that has $1 million in cash, right? We have an SBA 7A loan at broken up into two parts, one at $4.8 million, and then working capital loan fees of $200,000. Now, the loan fees on SBA can be expensive. They are rolled into the closing cost, but majority of lenders always kind of put a little more working capital in there just to make sure that if any costs come up towards the end, it gets financed into the loan. In this case, there's a small pari passu or second conventional note of $700,000, and then there's a conventional line of credit of $300,000. Okay, so again, total project cost of $7 million, but the borrower is only going to be borrowing $6 million. Right. So
can I ask a question here, Angel? Because I don't think we talked about this earlier. What is the difference between the SBA portion of the loan and the conventional portion of the loan, as far as, are they going to be on the same rate, same amortization? What do you typically see there?
Yes, typically they are the same rate, and typically they are the same AM. Sometimes underwriting will want to shorten up the second note, the pari passu portion, but most of the time they will keep it the same 120-month AM that the business acquisition is on, just to keep cash flow as strong as possible. Now, if the deal can really absorb, a lower amortization on the second note, then great. But normally they keep everything at 120 months, which is what the average acquisition term is. Now, if there was real estate in these deals, we can sometimes do a blended term of like 18 years or 16 years, or sometimes as high as 25 years. Now, in a scenario like that, it's unlikely that the pari passu would be a 25-year note, right? That would most likely be shrunk down, just because no bank is going to want basically unsecured debt out there for 25 years, right? So they're going to want to shrink that down. But that's what the lender's job is really to try to find the best structure for the deal, the best structure for the deal to make the cash flow as strong as possible. But every lender will work that differently. Again, there's only a couple of lenders in the country that do pari passu, and we all do it a little differently. But that's kind of how we would look at it. If it was a blended term of 16, 17, 18 years, most likely the pari passu would be shortened, because risk-wise, from a bank's perspective, it's just not safe to keep $3 million out there when, you know what I mean, when there's not a lot of not backing it up, right? So, but that's something that, as a lender, if I see that needs to happen right away, I bring that up immediately, because sometimes I'm not the right bank for the deal, right? So I want to make sure that the brokers and the lenders and the borrowers and buyers understand that, hey, I don't know if I can do that. I don't know if I can stretch out another $2 million for 25 years, right? So, but that's kind of our job to figure that out. So yeah, so every lender will do this. They have their own spreadsheet. Some of them have spreading software. One of the things I like to do is I like to share my spreads with my brokers and my clients, because I want them to see what I see, right? I want there to be transparency. I want them to understand why I'm saying what I'm saying. And everything that I do, they can duplicate, right? Some lenders, they don't have access to share those kind of things, but luckily we do. So this is the first step of understanding how the deal looks. The second step would be to go into the cash flow portion of the deal. So this is where I look at financials, so tax returns, interim financial statements. I look at AR, balance sheets, right? This is where we start getting into the nitty gritty. But at the end of the day, look, I'm not a CPA, so I try to keep it as simple as possible for myself and for the buyer. So what I do is I take the tax return and basically I try to find the matching line items. So gross revenue, cost, officer salary, rent, interest, depreciation, and I plug these numbers in. The spreadsheet's smarter than me, so it does all the math for me, right? Now, one of the things I want to point out, and this is something that a lot of buyers don't look at or brokers don't look at. If you look at line 23 in the spreadsheet, we use net income from the schedule M1. That schedule is typically under the balance sheet on the tax return. Okay. Now there's a big difference. So the M1 would typically remove like non-revenue generating income. So let's say somebody got a PPP loan, right? It's typically taken out of there, right? And there's a whole bunch of different reasons why the M1 would be different than the net profit line on that first tax return page. So I would employ buyers to look at that M1, look at the schedules. Typically what you'll see is, you'll see in that box that say statement 10, $340,000, and that might be a deduction off the net profit. You want to understand what that is. But that's something I think is important for buyers to look at, because sometimes they look at a net profit, or brokers will really push SDE or seller discretionary earnings, and that doesn't make a lot of difference to the bank. Like, we do not care about SDE. We want to see EBITDA. We're only going to be taking a few add backs, and the add backs have to be verifiable, right? So an example of verifiable add backs could be 401k injections, benefits, family salaries, owner salaries, a vehicle that's going with the owner and the payment's not going to be there anymore. Things that are easily verifiable. Things like travel expenses, that's going to be really hard to add back, because the owner's not going to give us a receipt for every single thing they use when they travel, right? They're just not going to do that. So from the perspective of the broker, banks want to see add backs that are verifiable and make sense. From the buyer's perspective, you also want to look through that noise and understand, hey, what is a true net profit of this business? And you want to look at the schedule M1, which is right under the balance sheet on the tax return. And it's typically always in the same place.
That's a great tip. And I think a lot of people are not looking at that. Quick question. When you're talking about STE versus EBITDA, do you prefer EBITDA because you're not adding back the owner's salary when you're doing your spread?
So in this case, we look at EBITDA. We don't add back, for example, in our underwriting, we don't add back taxes typically, because taxes always have to be paid to some degree every year, right? And depending on the business, sometimes they're really taxed really high, especially if they're like a specialty business, like an environmental company, right? They have licenses they have to pay for, things like that. So we look at EBITDA, and what happens is we do the adjusted EBITDA, like for example here on line 32, after all add backs or all deductions. So, I'll go through that right now, just kind of this, so that, your viewers can understand, hey, this is what most lenders will look like. So the spreadsheet is smart enough to automatically add back interest, depreciation, and the amortization. Okay, so it does that automatically on line 25, 26, 27. We always add back owner salary, okay, with the understanding that the new owner may have to take a salary. So typically what happens is, if the owner's salary, the current owner's salary is 160, but the new owner is going to take back 160, you won't see that add back, because they whitewash each other, right? But if the new owner's salary is $200,000, you may see a further deduction of $40,000 or $50,000, right? Because now we have to make up that difference, right? So this spreadsheet will take the last 3 years and say, if the current situation is X, which is salary differences, whatever, what does that look like if it was 3 years back? And sometimes that's where deals fall apart, right? So like in this case, owner's salary is 156. This person's going to take a salary of $160,000. Okay, so there is a difference there. Obviously in 2023, the owners took out 196, so there was a little bit of savings there. But most years, it was a little more, right? Now, the one thing you'll notice here is CapEx, which means capital expenditure. This is something that I'd say 99% of brokers do. If there's a business that has a lot of depreciation, which if you look here on line 15, this business had a decent amount of depreciation every year, right? We want to understand what that depreciation is, but typically a business that has a lot of depreciation will be replacing equipment on a consistent basis, which is that's money that goes out every year. A lender is going to want to account for that. So what we do is we take depreciation that's over 100 grand, and then we deduct 25% of that off, right? So if depreciation was $100,000, you'll see an adjustment for $25,000, which builds in a little buffer to say, okay, they're going to be spending money on replacing equipment. That could be, it could be tools, it could be anything, whatever it is. But again, we dig into it because sometimes like a manufacturing business, for example, may have a huge repair and maintenance cost. So we want to understand what the difference is, right? Did you really replace a machine, or is repair and maintenance cost going into things you're depreciating? Like, we want to understand what those things are. But in this case, they had some adjustments for depreciation in 21, 22, and then in 23 and 24, there wasn't any depreciation, but we all know they're replacing things, right? If you're a business that has equipment, you have no choice but to replace equipment, right? So we plugged in a number there just as an estimated CapEx amount, okay? Now, this business is incredibly healthy. Like, even with all those adjustments, interim is at a 2.0. 23 is at a 1.6, 22 is at a 1.8, right? And even 21 is at a 1.29. So this business is incredibly strong, But again, most businesses this size are, right? Like that's not where the issue is. Specifically with this deal, we have some financially strong buyers, but there is a gap in experience. Right? So now my job is to massage that and bridge that gap. Like, how do we do that? Right? But as far as cash flow wise, this thing is great. This thing works awesome.
This is super helpful, Angel. I think this is great for everyone to see. I want to go back to one thing you were talking about, which was taxes. Because I actually was working on a deal recently where someone brought it to me and they were like, this is super strong deal. They were giving me an EBITDA number. Dig into it more. They were adding back taxes that were essential to the operation of the business. And there's different types of taxes, right? There's taxes on revenue, like state and federal income taxes. And then there are payroll taxes. There are licenses and fees that could go in that taxes section. So my understanding is that you would not want to add back taxes that have to do with operating the business, because those are taxes that are going to be applying to the new owner of the business. Am I understanding that correctly?
Yeah. And really the taxes, I mean, honestly, if you have to add back taxes to make the deal work, it's not a good deal. Right? Like, let's keep it real, right? Like if a tremendous amount of add backs are needed to make a deal work, then the business is probably overvalued at that moment in time, right? Because you need all the add backs to make it work. So taxes typically don't really move anything one way or another, because it's not a huge part. It's not a huge expense of the business, unless it's a really specialized business, like a demolition business that, blows up buildings, right? They have to have all these permits. They have to pay all these fees, right? Things of that nature. But like, for the most part, if there's something that's a tax that maybe was a one-off that year, most brokers will let me know that ahead of time, and then I can explain that and add it back. But if $20,000 needs to make the deal work, that's probably not a good thing, right? Like, we shouldn't have that. We shouldn't be that tight, because what happens if that thing happens again next year and revenue stays the same and expenses stay the same? Now you're underwater a little bit. Right? Or you're under that debt coverage, what we need. So yeah, but you are correct in that assessment. Like, typically taxes that are needed for the business to operate, we obviously would never add that back. But if there's a one-off that year and it's substantial, yeah, I'll fight to get that add back in there.
I have seen sometimes, I'm no expert on tax returns,
Me neither.
but I've seen, I don't know why this is the case. Some tax returns, federal tax returns, will show a state income tax as an expense on the tax return. Would you add back an income tax?
That's a good question. I guess it depends how they're showing it. I would be curious what the M1 says. I don't think I've ever noticed that on a tax return. And especially if it's already built into the tax line, I'm not going into that. I'm not digging into that tax line item and saying what is this numbers made out of, right? I'm not
Yeah.
digging into that. Now, so unless somebody brings that to my attention, I probably don't go in that deep, and neither does underwriting. Underwriting really won't go into that. What does this $100,000 tax item break down to, right? Is it
Mm-hmm.
income tax, the federal tax? They're not going to do that. So I would say if that's something that is specific to that business for whatever reason, definitely bring it up to the lender and see what they can do with it, because any dollar amount added back in helps. But then we're going to have to justify narratively and maybe provide evidence of why this add back should be taken into account. And sometimes that's easier said than done. So
Yes. So when you're doing your cash flow, you are analyzing it pre-income tax, right? Like you're not doing an estimate for how much the business is going to have to pay in state and federal
Correct.
income taxes. Okay.
Right.
And I
Right.
think that's where there's maybe some confusion happening with folks is like they're putting taxes all in one category when there are different types of taxes, and you can't just go adding back the entire taxes
Right.
line item. And to your point, if a deal is dependent on, a $20,000, $50,000 add back, that's probably
Right. Yeah,
not
it's probably too tight of a deal, right?
Yeah.
The price has to be adjusted in some way, or more equity injection has to be put in, something, or a combination of the two, right? Seller note, but yeah, I would say, for your buyers, again, if add backs are needed to make a deal work, and they don't, and there are things that typically wouldn't be added back, you probably want to see if you can negotiate with the buyer to do something about the price in some way.
Mm-hmm. Okay.
So
Angel,
yeah,
this has been super helpful.
no problem. No, yeah. No, I'm glad. Yeah, and again, every lender does something different. They have a different software, a different style, but the discipline and the way it works is still exactly the same, right?
Mm-hmm.
So the buyers can use this video and say, okay, here's what these lenders will look for. Let me make sure I look at the business in the same way they do.
If you like this content, make sure to subscribe and check out the links in my show notes for ways to get in touch with me to discuss your business acquisition deal.